in Asia down on some worries that the Chinese economy is stuttering. And of course, this month in August, we see OPEC start their new supply arrangement where they are increasing by 400,000 barrels a day per month. That's why Walter's smiling so much this morning. But let's kick off with Adi Imsirovic, a senior research fellow at the Oxford Institute for Energy Studies. Adi, it feels to me like we're kind of caught in a sort of vortex between China weakening and COVID resurgence versus U.S. bionic strength and vaccinations. It's the battle of these two and who will win out. And in the meantime, we're stuck at 75. Your thoughts this Monday morning?
Good morning. Thank you for having me, Sean. You're absolutely right. I think there's a bit of tag of war going on at the moment. And it's probably just not just these two factors. There's a number of very, very difficult factors. The Chinese PMI came down, manufacturing PMI came down to a very low level, below expectations, just over 50, which is not very, very good. I think the COVID cases have been reported in, I think, at least 8 provinces in China at the moment. Pakistan's been badly hit. Florida's been badly hit. We know Australia. Now we have Southeast Asia, further cases in Vietnam, Malaysia, and so on. So that's all on the negative side. On the positive side, we've got this $1 trillion bipartisan deal in the United States that will certainly support the macro situation. We had the Fed last week. We had a big, well, not big, 2% jump in oil prices last week on the back of Fed positive comments on the economy. Consumer demand in the US is off the charts. We've got gas oil demand actually very likely to exceed pre-pandemic levels. Of course, jet is still lagging behind. On the other side, bullish side also, we have a situation with Iran. I think we'll probably talk about that. And then again, there are some other bearish factors such as India, China, SPR sales. Even the US is talking about SPR sales. So it's a very complex market at the moment. Having said that, I would just say that overall, the market is tight. Fundamentals are tight. If it hadn't been for these new COVID cases, I think we would have been well over $80 right now. So fundamentals are all pretty good.
Let's bring in Bora Bariman, managing partner, Hormuz Straits Partnership, sitting in London. Bora, we had the Fed last week signal that they're not going to do anything regarding changing direction of their policy. They indicated that the labor market outlook looks rather robust. We have the UK moving this week, or UK Central Bank announcing their outlook this week. All in all, it seems that the major economies in the West, at least, are living with COVID, and despite the resurgence, it isn't proving as of yet to be a disruptor to the recovery. Your thoughts?
You're right, and I believe that's being driven by the indication from the Fed and with the European and UK central banks being so closely aligned with the, let's say, outlook of the Fed that they're telling us they will get off the highway of quantitative easing and zero rates, but they're not telling us at which exit and at what speed they're going to take that off ramp. So for the time being, you'll see, especially U.S. stocks, continue at all-time highs, both nominally and by any other measure, such as overall market cap to GDP. You'll see home prices at all-time highs, again, both nominally and when compared to mean wages. And interestingly, incomes are also at all-time highs, but not compared to the assets, such as the ability to purchase a home. So interestingly, the Fed is looking to kind of bring those incomes up with low interest rates and bring up labor participation with low interest rates. But I would just conclude that I don't really see that happening. We've tried it for some time, and it's resulting in the K-shaped recovery. The top of the K, the asset owners doing very well, whereas labor they're basically benefiting from rent moratoriums or some debt moratorium, certainly that fiscal stimulus that Biden came out with. But it doesn't seem to be the, let's say, cure to the malaise for the bottom of the K that we had been hoping for.
Let's welcome Walter Simpson, Managing Director of CCED in Muscat, Oman, a small oil operator, independent oil operator there, but producing enough barrels, Walter, to have a smile on your face, as I said earlier. And all oil producing companies who had bionic second quarter results, not too perturbed by these wobbles when prices in Brent are $75 a barrel. That's way beyond anybody's expectation this year, I suspect.
Yeah, Sean, good morning to you. Good morning, everybody. Absolutely. Certainly well above any of the planning assumptions that we made for this year. So very happy with the way prices are. But the bumps, I don't think they're a surprise, if I'm honest. And I'm optimistic about what's going on. And part of me wants to say that I'm actually glad the bumps are happening now, because it reminds everybody that we're going to have to live with this for a while. And that we're not out of it and probably won't be out of it for years, never mind months. And so it's about adapting to it and changing some practices to work with it. And I think that's better that happens now while we're coming out, rather than we've had a period of stability, everybody thinks it's over, and suddenly we have one of these bumps. So I'm very optimistic. I'm happy with oil prices where they are. As I've said before on this show, I'm not keen on them going over 80, if I'm honest. I'd quite like them to stay about where they are. And I'm pleased with where we are, and I think it's just a bump we're going to have to live with.
Walter, in terms of the sort of noises out of China, of course, we're getting data points and surveys, but on the tangible, practical, obviously, Oman sends most of its oil to China. Are you guys seeing any ripples to demands or import going into China, or it's as strong as it's been all year?
No, as strong as it's been all year, not seeing any ripples at all at present.
Interesting. Adi, looking to forward from the point of view of where this OPEC Plus agreement goes, we're up 400,000 barrels per month, per day, per month for the next 5 months. There was a sense only a few weeks ago that was quite a bullish move, given that the demand outlook was scheduled to be much greater than that. Do you think it's still in that framework, still too little for what the market needs, or have they sort of caught the zeitgeist right here?
Well, I think they're fairly, lucky here as well, given that it was a bullish signal originally. We saw the prices go up 2%, but actually now with all the sort of COVID situation, not that, I don't want to be too pessimistic about it, but it's still the government measures always are likely to impact on the demand. So I think OPEC situation at the moment is pretty much OPEC Plus is very much in control, it seems to me. Even though the Saudis have increased their output, I think in July quite a bit. I think, and
they've basically taken back that 1 million barrel a day cut they made unilaterally.
That sort of discretionary sort of 1 million barrel, they're taking back a little bit of that. And even though we've seen the compliance within OPEC slip a little bit, it's still well over 100%. So I think all of that is bullish. If you don't mind me, just come back to that earlier point you asked Walter about China and Asia. I think the PG barrels are not going to be much affected. What is happening? The steep backwardation in Brent has widened the Brent Dubai. So all the other sweet Atlantic barrels are finding it very difficult to come to Asia now because the ARB's been shut. So even India has been buying very little West African. I think all the other barrels that normally come from Europe into Asia are struggling with this steep Brent backwardation and wide Brent Dubai. But I think PG barrels obviously being priced on Dubai basis are not affected.
Bora, we're expecting this Monday morning, as we said, oil prices have opened a little softer in Asia, but we are expecting the U.S. government this week, according to reports over the weekend, to finally sign off on a $1 trillion infrastructure bill. I suppose it's in the stimulus bucket. One would argue they've needed to do this for many years. If you've ever driven on a road in America, it feels like you've just gone down outside Mumbai or so. In that sense, it's very third world. But nonetheless, $1 trillion, it'll be seen as a stimulus. Is it baked in the cake already, you think, or does it give this already inflated market more elevation?
No, I think it's baked in the cake, and let's see the results of this stimulus, because what I would like to see is it somehow generating above expectations employment, right? This is what the Fed is looking for. They're looking for strong employment rates, people coming back to work, and that's the trigger, so they say, into bringing rates back up again. Otherwise, we're going to continue to have this asset inflation with cheap liquidity. Again, who has access to that? It's the top of the K. So hopefully this sort of infrastructure bill will help the bottom of the K so that we won't have this, I call it a mixed blessing, right? Because we're all benefiting from these stock prices, house prices, we're feeling wealthy, but it is reducing the all long-term, let's say, return expectations that we should have from these inflated assets, right? They're not going to keep going up. At some point, the growth is going to decelerate. And perhaps, when we look at China, the Chinese authorities may be preemptively dealing with that and putting in measures to damp down house prices and the stock markets. And they don't want to go the route of the United States to have this like massive rally based on the cheap debt, because again, it's not underpinned by employment growth.
Walter, one of the outcomes, I think, of 2021 for most sectors is the fact of revenue returning while overheads, to a certain extent, are still depressed from 2020. So there's a bit of a win there. I'm just wondering, from an oil production capacity point of view, we're seeing all the oil majors still holding back in the US to a great extent. But generally speaking, as you look to, from an operations point of view, is the oil production sector going to find cost rising given all of these raw material inflations and general inflation across the supply chain? Is that likely to come back in and sort of tighten the potential for new capacity at these prices?
The very, very quick answer to that question is yes. I think it is, and I'm already starting to see it. Things are tight. And part of that is clearly driven by travel restrictions and by the COVID supply chain issues, etc. But no, starting to see prices going up. Access to labour is a challenge, and demand. Clearly, people are wanting to maximise their production, so there is a demand for things. So yes, I am anticipating we'll see price increases over the next year.
We've seen out of China a story over the weekend around steel, the restriction on steel exports coming out of China, given their need to serve their own market. That may have a follow-through impact on operations in the Gulf.
I think it will. We're already starting to see an increase in prices for pipe manufactured in China being brought into the region. So that is already happening. And certainly, they're not insignificant increases. So yes.
Yeah, everything does seem to be, it's not just in the single digit. We're talking double digit increases, 20-30% across the board. Adi, you mentioned in your opening comment the news over the weekend, of course, of this attack on the vessel, the tanker moving from Africa to the Middle East. But most dramatically overnight is the declaration, pretty definitive, from the UK and the US, that this was Iran. They very pointedly declared it to be so, even though Iran said, not me. But ultimately, it does feel like a slight escalation that would make the Iran nuclear deal, however compromised it was already, seem increasingly a difficult egg to fry.
I totally agree. I think even though most of the market have sort of discounted return of Iran anytime soon, this is not making it any easier. I think last time, which was quite a while ago when I was on your show, I think I mentioned that I think the sooner the deal is done, the better and more likely it is to happen. But I think now, as we see this dragging on, it's getting more and more complicated and it's becoming less and less likely to happen. So certainly it's a bullish factor, and it's not going to make it any easier for the traders to sort of factor into their prices.
Bora Bariman, managing partner of Hormuz Straits Partnership, bringing that point forward at this particular moment, because of course this ship was attacked not far from the Hormuz Straits, outside near the coast of Oman. How significant, Bora, do you think it is that obviously, sadly, 2 people were killed this time, which has been a somewhat of an escalation from previous incidents? But how difficult does this make it for ship financing, insurance, and all sorts of other things in terms of the operations in that region? Does it change the paradigm, do you think, in any way?
Certainly, the insurance premiums will go up. It's very difficult to, it's more complicated and it's more difficult to insure the regional risks than it was pre-COVID for a number of reasons. Primarily, I would say, it's the commercial reasons, right? We've had high-profile defaults and bankruptcies in the shipping and energy trading sector, but at the same time, this is not welcome. This type of, I would say, shooting incidents. Certainly, I don't expect an all-out war or something like that. These governments are, I think, too intelligent and sophisticated, and the world is at too much of a sensitive place right now. I see reasons for Iran and the U.S. to even collaborate in terms of stabilizing Afghanistan and not allowing that country to spiral out of control. The Israel-Iran relationship will be one interesting one to watch, though, and that Israel tends to take sort of unilateral actions, sometimes even leading the United States and not taking orders from the U.S. So it's a sensitive time, and but the ship finance isn't being done out of the GCC anyway. These asset owners are parked in Singapore or as we've seen, Israel, Europe, East Asia. They will continue to be able to finance their assets. The insurance is the tricky bit.
Yeah. Walter, we've seen OPEC supply reach the highest levels last month since this agreement started, and now we're going another 400,000 barrels per day per month this month. But the reality is, of course, that most of the OPEC plus countries are done. They can't really increase much more. They're sort of tipping their head off the ceiling. Does that make any difference to the dynamic or viability of this agreement going forward, do you think?
I think it's an interesting one, actually, because I think it squarely puts Saudi and the UAE in control, which means they've got the marginal barrels to drive the price. So in a sense, I think it makes life a bit easier for them, provided they can stay aligned, of course. But even then, the major flex in the market is with Saudi. So I think they've got the Trump hand in this one, in the sense of how they control what goes forward. The rest of the OPEC, as you say, flat out and can't really do much more. And clearly, with as we've just discussed, with the additional barrels coming from other places seeming to be delayed, I think it's a good thing for the Saudis at present to be able to control the market.
Adi, your thoughts on that? So go ahead, Bora.
If I could jump in on that, you asked about access to finance and shipping, but certainly access to finance and upstream is the preserve of the super majors and the Gulf NOCs, I would say, and a lot of these sort of sub-Saharan African players with quite interesting assets are finding it difficult to engage with sophisticated investors at this time, and that's a problem that I've been trying to crack over the past few months, because there is a demand in Africa for the upstream finance, but channeling that is difficult at the moment, given the other alternatives, much lower risk alternatives that investors have to pursue at the moment.
Adi, your thoughts on that from the point of view of this moving forward? Of course, every month it's essentially fewer and fewer of the OPEC plus group that are in a position to benefit from these increases. Does it in any way jeopardize this agreement? And I welcome also your thoughts. We haven't talked to you since this agreement was done about this new quota levels beyond April.
Well, I agree with what Walter was saying. I think if anything, it's going to keep the cohesion of the alliance intact, because if anything, sort of the key player outside OPEC is Russia. Russia seemed to be struggling to bring back their volumes. In fact, there were several headlines in the last few days that they're very unlikely to increase their production by more than probably 100,000 barrels. So they're well within their sort of quota, and there's absolutely no reason for them to jeopardize this situation and these high prices. I think still, Sean, I think, all the talk is on the alliance, but I think the key is still on the demand side that we have to watch, because, we have great demand for gasoline in particular, naphtha. The one that's lagging behind, and as you know, the key to everything is at the moment is jet kerosene. If that demand was to come back on some positive COVID news by another, 2-3 million barrels, I think we would see a very, very tight market and prices well over $80 a barrel.
It doesn't look like, in Asia at least, that the aviation story is coming back in any tangible way like it is in Europe and America. And meanwhile, international travel everywhere remains well below domestic. So there's still some distance of travel on that. Let's get the survey question in and give everybody a chance in the room to sort of give their views on that outlook, sort of demand versus supply. But China slowdown and Delta variant versus U.S. strength and vaccines. Is Brent more likely to hit $70 next or $80 next? Which of these two? Will it hit $70 first or $80 first? Some days it feels like 80 and above. Other days it feels like 70 is not too far away. It sort of depends on your views. Let's get everybody's outlook for the week ahead. Of course, it's Monday morning. Bora, you're sitting in London. Oil prices are off a little bit. It's coming into the big holiday season now. How is that likely to impact the markets, do you think, and generally your outlook for this week?
Well, we're in the middle of the holiday season, and people are getting used to this reopening. Actually, I'm in Paris, and I see the malls are packed, the streets are packed, and they're quite sophisticated with their vaccine rollout, because on their next to their sidewalk cafes are their sidewalk vaccination centers, and it's quite impressive. I'm here because I had a short trip to the UAE. I couldn't fly straight back to the UK. So okay. I'm arbitraging quarantine regimes.
That's terrible. I mean, I have to feel your pain to have to quarantine in Paris. There
isn't one here for double vaxxed, so we're out and about,
right,
enjoying the town. But what we have seen is in East Asia, you don't have these sidewalk vaccination centers, and somehow it isn't being taken up. Let's look at that glass half full. There's something to be done there. If we're at this level of recovery without those stellar vaccination rates in Japan and Korea, they can up their game, and hopefully we will have them joining the recovery by the end of the year.
Well, Walter is sitting in a country in which is still very much in the pre-vaccination universe in some regards. We had a commentator on from China last week who was basically saying COVID is still really real in China, even if infection rates are low, because the protocol regulatory system is so onerous that every 5 minutes you're being checked for something. What's it feel like from the point of view of being in that space? Is the economy, is Oman, you were in total lockdown only a week ago?
We were over the Eid holiday. We had a curfew from 5 p.m. for a number of days, and then total lockdown for 4 days complete. That's been eased. Infection rates are down. And actually, in a sense, the Delta variant going right here and very high infection rates meant that actually the uptake in vaccinations increased and people got interested in having it. We're currently running at around about 2 million people of a 4.5 million population have had the first dose. So actually they're making progress.
Right.
And that drive is to get at least 65% of the population vaccinated, and they're working hard towards that. So I'm encouraged. Rates are down now. We still have a curfew, but it's from 10 o'clock at night now. And I'm hoping that things will start to ease here and open up. But it has been tough on the economy, and that's what's really driven opening these things up and trying to get some work back in place.
What about its impact? I mean, the fact that you're still in that kind of what might have been the experience of Europe or other parts of the world, deep in winter, a few months now opened up, but you're still dealing with that restrictive protocols to operations and field operations and all of those sorts of things.
It is a challenge. I mentioned earlier, shortage of labour. We are struggling. We had people in country. We kept them a long time because they couldn't travel. Then they did travel and they went home. Now they can't get back because there are very tight travel restrictions from countries that just can't come into. As Bora was saying, UAE, can't go back to the UK. Similarly, from here to the UK, and similarly from the UK to here. So there are a number of countries where you can't get in. And that's causing a problem for us. So there is a labour shortage as a result of that, and it is a challenge, but not a new one in this environment.
Yes, well, you're probably well used to it at this stage. Adi, let's get the survey result and give you the last word this morning. More likely to hit 70 than 80 next. That's a kind of a 60-40 split in this room. Your thoughts on that, Adi, and where we go with this sort of outlook, given that COVID is really very disruptive in some places and less in others?
Yeah, I mean, I was one of those who voted for 70 first. I think even though I started this whole thing on a bullish note, and I think the market is still very tight, I think we are very likely to see a bit of a soft patch for maybe at least a couple of weeks. The main reason being lack of Chinese buying, I think for several reasons. One is lack of quotas for the teapot refiners, and the other one is the one I mentioned already, the arbitrage being shut to Asia for the Atlantic-based crudes. So I think that's the one to watch. On the top of that, the news from the sort of COVID side have not been particularly bullish either. On the macro side, as Bora mentioned early on, I think the sort of the $1 trillion thing is already priced in. So if anything, we're going to see a bit of I think we're likely short-term see a bit of a soft patch, market sort of calming down. OPEC is supplying enough oil into the market before we move on, hopefully a little bit higher later on.
Given that point, Adi, are you surprised that Saudi OSPs were as high as they were into Asia?
Well, no, not really. I think that at least the market expected higher OSPs and will expect them for a little while. The main reason is the sort of the lighter grades, Arab Light and Extra Light, see very good demand for naphtha and gasoline. So that's why you saw very high sort of numbers for Murban as well at the close of the contract last week. So I think those grades in particular are going to do very, very well. On the other hand, sort of heavier sour grades are slightly under pressure, but otherwise, the market is currently driven by gasoline. If you look at the margins are better. They're primarily better because of naphtha and gasoline, whereas the rest of the barrel is kind of still being left behind. But what we need to do to get really bullish for the rest of this year, we would need to see that diesel demand pick up, which is always correlated with industrial activity.
Well, let's wrap it up there. This 2nd of August, the first trading day of the month, the first trading day of the Brent contract, and we're down over 1%, just dipped below $75 a barrel this morning in open early trade in Asia at 74.58. Still a very strong number, way beyond perhaps most people's expectations earlier in the year. But nonetheless, we're stuck in a tug of war, and perhaps we'll remain there while everybody's at the beach. Walter, thank you so much for joining us from Muscat. Adi from London and Bora from Paris. Take care. If we don't talk to you, have a great August. We'll catch up later in the month. All the best, and we'll be here every morning this week at 10:30 UAE time before the show takes a break for 2 weeks after that. All the best. Thank you.
Thank you.